Now, coming back to the withdrawals then, we know EPF withdrawals tax-free. We know all contributions to approved scheme under Section 150, tax-free withdrawals. Okay, so now the question of PRS, okay, and other deferred annuity schemes. Approved by SC for the PRS and approved by Bank Negara for the deferred annuity schemes. Okay, so is it tax-free? Does it come under exempt from income tax? Technically it does, because at the end of the day, don't forget, the objective of this is for the tax authorities is for the country, the government to encourage retirement savings. Okay? So it must, in order to encourage you, you cannot be taxed on something that you've saved over the years. Okay, so yes, withdrawals is exempt, provided it's withdrawn at maturity. And what is maturity? 55, okay? So that 55 comes in again, at retirement at 55, okay? So early withdrawals of PRS, and so the tax authorities put a stick into this, okay? Early withdrawals of PRS funds. The tax authorities last year just announced that if you withdraw before 55, or of course there are certain conditions upon, for serious illnesses, death, or permanent departure from the country and all that, yeah? Any other circumstances will be considered an early withdrawal. Those kind of early withdrawals will be subject to an 8% withholding tax at source. Upon withdrawal, your PRS provider will need to give you 92% of it and pay over 8% to the income tax authorities. That 8% is final tax. So you don't claim it or offset it against anything else. So you don't even need to report that income in your Form B. Okay, tax at source, final tax. Unapproved funds, how are they subject to tax? Only upon withdrawal, but only for portions that has been contributed for you, not through your own gross income. Your gross income has already been subject to tax. So just think EPF. 11% comes from your gross income. Your gross income you report in your EA anyway, right? The employer's contribution, that 12%, or 13% for some people, okay, or excess for other people, okay, is actually not EPF, unapproved scheme. I'm just likening it to how, there could be an employer-employee contribution. The employer contribution will be subject to tax if it's contributed to an unapproved scheme at the point of withdrawal. Okay? So which portion is subject to tax? In a fund, you have the investment portions as well that gets rolled in. You have the contribution by the employee, the contribution by the employer. Okay, the tax authorities again just informed us that the portion that will be subject to tax upon withdrawal for any contributions to an unapproved scheme will just be the employer's contribution only. Okay, so it doesn't take into consideration all the interest or dividends that's paid into the scheme. A very good question. We see that all the time. Yeah, you have your long service awards, you have your good performance awards. Yeah. Gifts on its own, okay, the tax authorities the company might call it a gift. Okay, I'm really thankful to this person, so therefore I'm giving him a watch. Okay, now if you look at all the old UK cases of how they analyze that payment, I think the question of, is it a payment for having or exercising an employment? I think that analysis needs to come back in. Is that watch given to you because your company likes you, a personal liking? Or has it got to have something to do with the performance of your duties? Okay, so 10 years giving a watch clearly is for service. Yeah, because you get it only after having worked with the organization for 10 years. So likely, for those kind of gifts, likely to be taxable. But there is an exemption up to 2,000 against the value of the watch. Okay? The other area of complexity is, how do you value that watch? Do you take the market value? Do you take the value that the company purchases it at? If I engrave your name at the end, doesn't the value drop substantially? You know, that again is another question to ask. What is eventually that value that I put into that EA? So, you know, this really brings me back to the point of, you know, the substance of that payment needs to be analyzed in order to finally determine what actually goes into that EA. Okay? It doesn't, okay. Okay, again a good question, but what is subject to tax on the taxpayer is a different level from what the company gets taxed and what the company claims as deductions. It is not dependent one on the other. Okay, so again, you know, coming back to how we apply our legislation, every pocket of income needs to be analyzed at that exact level of who is the recipient of that income. Okay, I'm going to take one more question, and then I'm going to request all of you to maybe ask the questions at the end of the session. Okay?
You and your employer agree on that pathway.
Okay.
In return for a lump sum payment, right? So is this lump sum payment taxable?
So is the company making that individual, are you shortening the contract for this person? That means if you didn't enter into this mutual consent, would the employee continue working with the organization? I know a lot of times a redundancy or a severance payment actually is an agreement within the individual and the company. Okay? And the consideration, of course, is the compensation payment that's being made to the individual. Usually that would be a compensation for a loss of rights. So you have a right to continue employment, but I would like you to go, so you agree to take a payment for letting you go early. So usually that will clearly fall into the pocket of a compensation for loss of employment, and then hence that 10,000 is applicable.